All right, welcome once again. This is financial accounting, and today we want to basically look at the cash flow statement, and we want to see how that is applied when you're preparing, especially for exams that are upcoming. So right with me here is a question. Right here is a question of November 2018, which we shall be able to use within our study. So as we can see here, this is Caron Limited, and at the bottom here, one of the things that they're asking us is to prepare a statement of cash flows for Caron Limited for the financial year ended 30th April 2018 using the indirect method. Now, before we proceed, I want us to just go through a key concepts on cash flow statements, and then we can be able to build on that to try out this number. So cash flows are one of those key financial statements that we basically have, just like the way we have the statement of financial position, the income statement, and the statement of changes in equity. We also have the cash flow statement, and cash flow, basically from the word cash and flow, basically help us to understand how cash and cash equivalents have been able to flow within the organization. Now, when we say cash equivalents, we mean items that are nearly cash. They're basically high liquid investments that can easily be turned into cash. Some of the examples here, like we are seeing money market funds. In Uganda, we have, of course, money markets that are traded on the USE. So those could be one of those. Travel checks could also be one of the cash equivalents that you could look at. You look at treasury bills, because treasury bills are usually securities of less than 3 months. That also applies to Uganda. Also, our treasury bills would also fall under the same category. So that's what happens with cash equivalents. So we look at cash and then cash equivalents. Of course, cash is itself the cash at hand. So cash flows, where we are preparing cash flows, we have three components of cash flows. Basically, just like the way when you're drawing up your balance sheet or statement of financial position, you have assets, liabilities, and equity. Now, for cash flows, we have what we call operating activities as the first section. We have what we call investing activities. And then we finally have the financing activities. So when you're drawing up your cash flow statement, those are the key areas that you're going to look at in terms of preparing your cash flow statement. So what these terms mean, or what exactly goes under each. Now, operating, from the word, of course, operating here, we are trying to look at cash flows that are generated by the business in its day-to-day running. Basically, here we're trying to look at cash from sales. We are trying to look at maybe cash payments for, let's say, purchases. We are looking at payments for, let's say, expenses like maybe salaries. We're trying to look at areas within the business that take cash on a day-to-day basis, but also look at areas that bring in cash. Remember, when you're looking at cash flow, we have two components also in terms of, we look at cash inflow, which looks at cash coming in, and then we look at cash outflow, which represents cash moving out. So each of these sections, we shall have elements that represent cash inflow and cash outflow. The same thing will also happen when we come to, let's say, investing and then financing. So operating activities is basically the day-to-day, the selling, the buying of raw materials, the paying salaries or wages, and many other aspects. And then investing activities, here mostly we look at investment in long-term assets. So you look at aspects of buying and sell of fixed assets. So when an organization buys a fixed asset, that is regarded as a cash outflow because we use money to buy these assets. If an organization sells an asset, then the proceeds are recorded as a cash inflow. So those are the kind of dynamics that we usually have when it comes to investing activities. And then the financing activities, this looks at the aspects of how we source capital as a business. So businesses source capital either through shares, they can also source capitals through debt, among others. So when we are looking at financing activities, we are looking at, let's say if we've issued shares, that is a cash inflow because as we issue shares, the shareholders pay money and that money comes in as a cash inflow. We can also look at things like dividends. When we are giving dividends, dividends are more of like a cash outflow because we are paying the equity holders within the business. The same thing with the loan. When a loan is coming in, we look at it as a cash inflow because as a business, we are taking a loan and cash is flowing to the business. Well, when we are repaying, this is more looked at as a cash outflow because here we are actually paying out cash out to let's say to the bank where we borrowed this money. So that is how these three key elements. So with this way of preparing our cash flow statements, we believe that businesses perform all activities and all activities fall within the three categories: the operating, the investing, and the financing. So those three key activities are the ones that bring in cash and also take cash. So if we look at operating, we shall go ahead to look at what has come in and what has gone out. And then we're able to get the net cash flows from operating activities. The same thing with investing. We shall also look at what has come through as through cash through the investing activities. For example, what has come through the sale of disposal of fixed assets, and what has been paid while acquiring maybe fixed assets like such. So that's how we go about. So these key parts of our cash flows are very important when you want to understand how cash flows basically flow. So apart from that, one of the things that also we need to appreciate are the different methods of preparing our cash flow statements. Now we have two methods. We have the direct method and the indirect method. We have the direct method and the indirect method, and we are going to appreciate how these two methods basically work. So when you look at, I need to basically start, let me just try to see if we could, okay, let me first start specifically from, let's say, this is, okay. So what we are seeing here is basically the indirect method. Now, let me just try to demonstrate this in the Excel for you to pick something. So just to recap a little, I said our cash flow statement has three sections. So we've said that we have cash flows that are coming from operating activities, which I'll just try to put here. So you can say cash flows from operating activities. We also have cash flows from investing activities. And then we also said that we have cash flows from financing activities. Okay, so these are the three key sections. Now there are elements that happen in under each of these. Now I want to just differentiate between the direct and indirect method. Now, one thing that we need to appreciate, if, for example, this is the indirect method of preparing, and then maybe I'll have also the direct method as well. Let me put it here. So let's assume this is the direct method. So what happens with the direct and indirect method? Both of them have the three key sections. Both of them will have a section on cash flow from operating, will have cash flow from investing, and then cash flow from financing. But when it comes to cash flows from operating activities, the two have different ways of how we prepare. Now, when they say cash flow, this is not something that should confuse you or something that you should see to be maybe hard. This is the direct cash that you understand. Now, the direct method tries to look at things directly. For example, we know that operating activities is looking at cash flows that do with the day-to-day, let's say sales, purchases, and so on. So it will have items like cash sales. So let's say maybe you have 1,000, just try to use sample figures here. And then to have, let's say, receipts from debtors or receivables. Maybe this is 200. Like these are the guys that you sold on credit some time ago and now they have paid you. It will have things like, let's say, payments for raw materials, for purchase of raw materials. Let's say maybe it's maybe 400. It will have like things like maybe payments to staff, maybe payment for wages. And let's say maybe this is 100, but now this one is made negative because it's a cash outflow. As we can see, the whatever is cash coming in is being recorded as a positive. So this is also negative because cash is moving out like so. So we're able to list all the cash inflows and everything that brings in cash that relates to operating activities, and anything that takes out cash as well. We're able to list it out. And at the end of the day, we should be able to get our net cash flows from operating activities. So for example, for this case, net cash flows from operating activities will just be the net of this, which is about 700. So this is what we shall have. We shall have about 700 as what we have here from our cash flows from operating activities. Now, this is how the direct method works when it comes to the operating cash flows from operating activities. It brings items directly. Now, when we are dealing with the indirect method, here cash flows, we start with the profit, the net profit for the period. So we bring, let's say our net profit maybe was 2,000. Now, one thing that we need to understand is net profit comes from the income statement. And when we are preparing the income statement, we consider both what has been paid on cash and what has been paid on credit. That is if we are looking at, let's say, raw materials. But even for sales, we look at both sales that have been on cash and both sales that have been on credit. Now, the indirect method gets the profit and works backwards to remove any items that are not cash, that don't have cash in them. And then we are able to also look at, for example, when I say items that don't have cash, we look at depreciation, because in deriving profits, we deduct depreciation under expenses, but depreciation in reality does not involve any movements of cash. So such things will be added back. In case something was subtracted and it doesn't involve movement of cash, it will be added back. We shall look at taxes. We shall look at interest, because interest is also deducted in the expenses in determining profits, but not all the interest is actually paid within there. So it's basically an adjustment of your profit to reflect what is exactly only cash. And that is what is within here that I was trying to demonstrate to you. So when you look at this, this is the net income. We know very well that net income is the same thing as net profit. So if it's the net income, what happens is we go ahead to adjust the profit with different items, okay? Just like the way we have some of these items. So from here, like I said, we'll add back, let's say, items like depreciation. And the reason why we add back depreciation is because in deriving this profit, depreciation was one of the things that was deducted, but this is a non-cash item, so it is added back. Let's say maybe it was 500, okay? Then we might have, let's say we have a gain on disposal. Now, gains on disposals are also non-cash in nature. Basically, there is no cash movement. The gain on disposal is more of, it is, we call them notional accounting calculations. Basically, there is no cash movement. So if we have gain on disposal, we know very well that gain on disposal is usually added to the gross profit to get the gross income. So gain on disposal as one of the additional incomes is non-cash in nature. So what we do here, we actually less it. Why we less it is because it's already included within the profit, and we know very well that it is non-cash, so we try to exclude it. Now, all this that we are doing is the understanding that cash and profit are two totally different things. When somebody says I've made a profit of 2 million, it does not mean that ideally the 2 million is in the bank account, because the way we compute profit involves even items where we have not received cash or items where we have not paid cash. So that is what exactly we are trying to do here. So we are trying to separate items that are non-cash with those that are cash. And the cash flow statement, we only look at those that are of cash. So if we had the gain on disposal, it will be removed here. Okay. And so on. So we'll also look at interest. I said interest is also added back. Interest is one of those things that is deducted while you're determining profit. So interest is added back. We also look at aspects, or like maybe in case we have maybe taxes, maybe taxes had been also deducted originally, those ones also deduct them. We also look at items like changes in working capital. And by changes in working capital, we look at the different working capital items. By working capital, I'm looking at current assets and current liabilities. So we look at how those items have been able to change, okay? And so on. So we are going to understand that more when we look at an example, which is, we are going to look at, which is, I think this is 2017. Yes, 2017. This is 2018. So there's a question in 2018 that is going to give us an insight on how to do, because this one is asking us to use the indirect method. So at least you can appreciate the direct method And then when we do the indirect method by trying out this question, you're going to appreciate how that comes through. Like I said, these other items, these other two parts, the cash flows from financing activities and cash flows from investing activities are the same. Either you're using the direct method or using the direct method. So if the examiner asks you to use the indirect method, all they are trying to do is that when you're doing your cash flows from operating activities, start with the profit for the period and then work backwards. If you're doing the direct method, bring the items the way they are. And what will also happen in most cases is that when the examiner sets either the two methods, then they will provide you information that relates to that. When you look at this question, you get to realize that they have actually given us our statement of profit or loss. So we actually have the profit for the year provided to us here. They have also given us the profit before tax accordingly, which we are going to basically be able to use here. So for a question where the examiner would want you to use the direct method, they will give you the direct items like, let's say, receipts from customers, payments to suppliers. They'll give you payments for salaries. They'll basically give you those items direct. They will not give you a P&L, and then they'll ask you to figure that out. They'll be able to give you that information. So in most cases, as we can see, they have given us the statement of P&L, but they also go ahead to give us a statement of financial position. Now, this is again to re-echo that when we're preparing our cash flow statement, our source of information, especially for the indirect method, is from the statement of P&L, as well as the statement of financial position. So we use the two financial statements, this and this, to draw up the cash flow statement. That's why the cash flow statement is usually drawn up as the last financial statement. Okay, so that is one of the things that we also need to take in interest. So I'm going to go through the question, and then we're going to be able to conceptualize and see exactly what is ahead of us. Okay, so the question runs and says that Keron Limited, which deals in general merchandise, has provided the following financial statements for their ended 30th April 2018. So we have our revenue right there. We have our cost of sales. We have our gross profit. We have interest received. We know very well that interest can either be an interest expense, but it can also be an interest income. And it's an interest income when you have, let's say, money on a bank account, which is interest receiving, means that you maybe receive a given amount of interest on a given every month. So we have distribution costs, we have administration costs, and then we have profit before interest and tax. Then we have finance costs. I commented upon this and I said finance costs are also called interest. That's why you can see profit before interest and tax, then they remove finance costs, then they're able to get profit before tax. So the word finance cost is also a representative of interest. Then we have a profit before tax. We have our tax for the period. We have dividends. We have profit retained during the year, and so on. Now we go ahead to also be given our statement of financial position, which is at 30th April. So we have our non-current assets. Now, one of the things that we're going to appreciate here with cash flow statements is that they give us two periods. So they have given us 2018 and 2017. So there's movement between these figures. We can see that they started, for example, for non-current assets, they started with 400,000, but they now have 150. Now, each item in the balance sheet changes because of certain reasons. But one of the key reasons that could happen for non-current assets is an addition in the non-current assets. And that, you know, that additions also additions or disposals are included under investing activities. Anything that is to do with non-current assets is recorded under cash flows from investing activities. We are going to see how that works. We also have the investment at cost. We didn't have it in 2017, but we have it in 2018. I'm just basically looking at this figure and this figure. Then inventory. We can see that we had 103 here, but this dropped to 78, which means that we sold inventory along the way, which gave us a cash inflow. We are going to see, because when you look at current assets and current liabilities, we are looking at aspects of changes in working capital. We can see trade receivables. We started with 48. They are now 45, which means that there was increase in our trade receivables. That also means that we have a cash outflow. Basically, money was flowing out of the organization. We'll see how that affects us. We also have our bank, and then we also have our equity and liabilities. Now, under equity and liabilities, we also have ordinary share capital. And with ordinary share capital, we have, we started with 302,500, and we now have 450. For share premium, we have 79,050, and then we have 113,400. I believe that right now we know what share premium means. Share premium comes up when we sell shares at a price that is higher than the nominal value. So we shall see how that comes in. And then revaluation reserve. Revaluation reserve comes in when we revalue our assets, especially any current assets. And then we have retained earnings. These retained earnings, of course, to represent cumulative profits over the period. Then we have the non-current liabilities, which we are also seeing that they grew. The bank loan grew, means cash came through. And then we have, you come down on your current liabilities, trade payables, they were 25,500, they are now 18,555, so there was a reduction. And we shall see how that reduction reflects more of a cash outflow, because it means you settled the obligation, so it has reduced now, which more depicts a cash outflow. And then we're seeing a taxation also. We're trying to see how that changes. We also see the bank overdraft right there. We also see the dividends, what has happened with the dividends. So we shall also see, because the dividends also affect our cash position. And then right here, they give us additional information. They're saying plant, property, and equipment as at 1st May 2017 had a cost of 500 million. During the year, property had been acquired on 1st May 2016 and had a cost of 50 million, was disposed of on 1st November 2017. So there was a disposal, and disposal proceeds are usually a cash inflow under investing activities. I'm going to share with you the format, so you're going to be able to see that. The profit or loss on disposal has been accounted for in the statement of profit or loss. The accounting policy is to depreciate property, plant, and equipment at 20% on costs, and it's time apportioned. I believe right now you understand when they speak of time apportioned, means that if an asset was bought in, let's say, June, they only consider 6 out of 12 for the depreciation. If it was bought, let's say, in October, they will only look at the remaining 3 months when they are calculating the depreciation. So we need to be able to appreciate that. They're also telling us that during there was a cash issue of 9925 shares at 2,000 per share. So this alone is able to tell us that these shares were issued at a premium. And I'm making that conclusion because when you look up here, our share nominal price is 1,100. So every time we issue shares at a price that is higher than nominal value, like 2,000 here, means that there is basically share premium. So there's also a revaluation of property and plant and equipment, which was carried out in 2018, April 2018, and it's incorporated in the financial reports. So the examiner is asking us to prepare the statement of cash flows for Kenron Limited for the financial year ended 30th April 2018 using the indirect method. Yeah, one of the things, like I said, there are two methods of preparing our cash flows. In this case, the examiner clearly brought out the method to use. Some cases, they may not tell you the method to use, but based on the information you have, you can be able to understand that whether I'm going to use the indirect or the direct one, okay? Yeah, but mostly the examiner will clearly bring that out on what they want you to exactly use, okay? Yeah, so that is what exactly that happens. Now, maybe just also to just show you, let me just try to show you a format of our cash flow statement. Maybe this can help you. If you can be able to remember this, then it can be a good push for you. All right, so this is the format. I want you to look critically here. This may not be that very clearly, but I can read for you. So we can see that our first item is the net profit before interest. Now, like again, I just to re-emphasize that you start with the word, definitely you give it a heading, maybe cash flow statement for there, ended that. Then you proceed to have your particulars, maybe details, column, and then amount. Now, the first thing you start with is the net profit before taxation, okay? Net profit before tax. Here they're trying to add other extraordinary items. But for this, we may not have those. Let me just try to show you here. So here we have this profit before tax. This 43,210 is one of that. Then we have items to be added. Like I said, there are items that we add back. And one of those items is like depreciation, okay? And then we have items to be deducted. Now, just to record, these items to be added are items that were earlier deducted when we are computing profit, but they are non-cash items, or they were items that were not supposed to be deducted, okay? Just like the way you have bad debts. Bad debts is an expense, but in reality, there is no cash movement that has happened. So that will be one of the items that will need to be added back. Depreciation is one of those. If you, in case you had amortization, just again to say amortization is the depreciation of the intangible assets. And then we have the items to be deducted. These are items that were added at the time of computing profit. And I gave an example like gain on disposal. We can also have foreign exchange earnings. They can also be non-cash items as well. So after you've added and subtracted those items, you'll have what is called the operating profit before working capital changes. Operating profit before working capital changes. Now, working capital, I said whenever somebody says working capital, you think of two things: current assets and current liabilities. So for working capital, we now go ahead to look at each of the working capital items. And by missing working capital items, we look at your balance sheet. You look at items like inventory, trade receivables, and then you don't, bank is excluded. You don't look at this because you're trying to do a cash flow statement. Bank would be used at some level, but you come and look at your liabilities here. Your trade payables is one of the other things that you look at. So what you basically do is you're trying to look at their movements, how they have moved from the previous year to the current year. And what this is trying to mean, if their current assets, if current assets reduce, okay? For example, if inventory is reducing, in this case, let's see, our inventory was 103 and it's now 78. This means that we sold inventory and cash came through. So the difference is a cash inflow. And that's why they are trying to show you here that if it's a current asset, it is added. A deduction in the current asset is deducted, well, an increase in the liability is also added. Whenever your trade payables increase, just like the way we have them here, when you see our trade payables, okay, this one's decreased, but in case they were increasing, then it means that we're getting more money in the period. So cash was coming through. But right here where it was decreasing means that we started with 25 and they have dropped to 18, means that we paid some trade payables during that time. So the difference between this value and this value is more of like a cash outflow. So for it, it is actually deducted. So that is why you see they're showing us here that a drop in current liabilities, this other side is actually less. Well, an increase in current assets. Now, when current assets increase, for example, if inventory increases, means that you bought more inventory. So you use the cash. So there is a cash outflow. So that is what exactly happens. So after you've adjusted your working capital, you come to your cash generated from operations. And then you also reduce the income tax paid right here, okay? And this, they're trying to say net of tax refunds. We shall see how that comes. And then you also have items, in case you have interest paid, you also make sure you adjust it there. And then we come to, I just want you to appreciate this section because I didn't commented about it. Now, investing activities, again, I said investing activities are specifically to fixed asset, to the non-current assets and the investments. As we can see here, proceeds from fixed assets are added when you dispose of an asset and somebody pays you some amount of money. That is a cash inflow. Well, when you purchase a fixed asset and then you pay money, that's a cash outflow. So that's why you're saying this is a positive, this is a negative. And then we can have other items. They're calling them extraordinary items. It's more of any other items. For example, acquisition of an investment. You may, instead of buying an asset, you may buy shares in, let's say, MTN as a business. Now, the money that you have used to pay for those shares is cash flow from investing activities. So it's a cash outflow. In case you get dividends from MTN as a business, then that is more of a cash inflow because you're benefiting as an investor. The business is now the investor in another business. So the dividends are more of cash flow from investing activities. And then we have the cash flow from financing activities. Now, like I said, financing activities, it looks at the loans and the shares mainly. So here we're trying to look at the proceeds from issue of shares, proceeds from other long-term borrowings. In case we paid the loan, this will be an outflow. In case there's a redemption of shares, the word redemption of shares means a shareholder is able to get back his money for his shares, okay? If a shareholder is reimbursed back his money for the shares that he has in the business, it's a redemption. In case maybe we have a bank overdraft, which is also being brought up here. And then from that, you're able to get your net cash flow from financing activities, able to add cash and cash equivalents in the beginning of there, and then you're able to get your cash and cash equivalents at the end of there. So that is how we are going to approach this. So we are going to have this in mind and look for information within this question that we have been provided. Okay. So that is our intention. So I'm going to start. We will kickstart with what we have. Just a moment. All right. So let's work on our number. So I'm going to share my Excel where I'm going to work this number from. So this business is called Kenron Limited. So I'll have my heading as Kenron Limited. Kenron Limited is statement of cash flows. Now, when you're looking at statement of cash flows, we need to understand that when it comes to the heading, this is usually for the period ended. So this is for the period ended. Just confirm what date was this. This is 30th April 2018. 30th April 2018. So we, like I said, whenever we are starting, we start with the cash flows from operating activities. So cash flow from operating activities. So cash flows from operating activities, we say that those we basically kickstart our information from our statement of P&L. And what we basically look at is the profit before interest and tax. So the profit that we have before interest and tax is here. So we'll take this 44.7 that. So you come and put it there. Sorry. Put it here. So that is what we have. Now we are going to adjust this like we're told we add back and less, okay? So the question is, what items are we going to add back and what items are we going to less? Now, how you get the items that you're going to add back and less is you get to know from one, you can look at these items that were used in deriving this profit before interest and tax, as we can see. We have cost of sales, gross profit, interest received, distribution, administration costs, and then they came to profit before interest and tax. But also you need to understand that these are amounts all together. They are summing up all the other costs. So we don't see costs like depreciation appearing here, but yet in reality, such costs are there. So some of the costs are bulked up, so you have to look for them. Well, some of course, sometimes they may bring it when it is clear that you can easily see it. But for this case, depreciation, they just gave us information relating to depreciation here. So we have to basically determine the depreciation for the year from this information they have provided us down here. So that's one of the things that we are going to basically do. But before that, we also don't see any gain on disposal. Like I said, gain on disposal is one of the items. that would be able to see. But they have also told us something about that there was a disposal, so much likely there's a gain or loss on disposal. And then also, one of the other things that we can also look at is when you come here, this interest received. Interest received is basically this 25,000 is more of, like I say, this is like income, okay? Interest received is more of income, but interest received is not a cash flow from operating activities. Interest received is a cash flow from investing activities. Interest received is a cash flow from investing activities. Why? Because it's only items where you have invested that you receive interest. Interest is not received in the day-to-day cost of your business, okay? As a business, you don't receive interest in your day-to-day. So what I would do, even before I calculate depreciation and go ahead to calculate my profit from disposal, I'll first less. I'm going to less these items as I get them, less and add. So I'm going to less interest because it is within this amount. So I have to first remove it. Less interest received of 25,000. Now, since we are trying to prepare for the exam, I also want to say that for you to manage this, especially from a time perspective, as you have your cash flow from operating activities, make sure you leave space and come have your cash flow from investing activities, so that if you can be able to fill this information as you proceed across. So I'll have my cash flow from investing activities. I'll also go down, leave enough space, and have my cash flows from operating this is from financing activities. So like I've said, this interest that I'm removing here is interest that I'm going to put under here. So interest, cash flow from investing activities will have its first items as interest received, which is 25,000. Now, one of the things that you need to understand is the reason why I'm bringing that figure directly here, because they have put this word received. If they just said interest income, means that it would have what has been received and what has not been received, but it's income. But since they have said interest received, so this is directly the cash that has been received. So we recognize this direct. We don't have to do T accounts for this. But in case it was interest income, then we would also go ahead to look for the actual interest that was received to exclude any other interest that was not received during the period. So that's the first thing that I want to do because I also want to maximize on whatever I'm earning from this question. So that's why I'm taking that approach. So I'm going to do that, but also, like I said, I have to look for depreciation, and I also have to look for the gain on disposal. So what I'm going to basically do, I'm going to reread this text down here and do a T account and be able to use the information I have to be able to determine. Definitely, you would say that the depreciation would have appeared under what? Under our statement of financial position, but by presentation, they only gave us the net book values. So we cannot easily determine depreciation. Even if, for example, this was 2017 and it was 400 and now it's 46, we cannot even get the difference and say that is depreciation because the figure actually even increased. You get it? So we have to exclude the additions which they have told us about, because they have some asset additions, until we're able to determine our so-called depreciation. So for us to do that, we are going to draw up our T account, and that T account is basically going to be for the plant and machinery. So I'll just come here. I'll have a tab for working. So you put your workings on another page and say working 1. This is, I'm going to draw up my what? It is a plant. It is the PPE account, okay? I can call it PPE account, or the non-current assets account. Plant, property, and equipment account. Most businesses combine all the assets into a single account like this one. So it's what we are trying to do here. So once I have this, I'm now going to look for my information. Now remember, we have a balance brought down. So when you come here, this is your balance brought down. But remember, these values are in net. We don't have the values at cost. So we are going to use the values as that are net. So I'll just come here and say, since this is plant and equipment, plant, property, and equipment, it has a balance brought down of 400. That. And one of the things that we also appreciate is that they have given us the balance carried down. The balance carried down is this. So you also go and take it. They have given us the balance carried down of this. So that's the first thing that you do. You have the balance brought down, you have the balance carried down, because the reason why we're drawing up this is to determine what exactly happened, influenced to come to this. Because one of the things that has influenced this balance is depreciation for the year. But then we also have additions. So we want to exclude additions, exclude any other changes that happen, even disposals, so that we can be able to determine what is the actual depreciation, okay? Since these values are in net, means that the depreciation is also handled in the same account. Most of the PPE accounts that you've worked with are where we have items on cost, where we have an account handling items on cost, and then we have a separate depreciation, accumulated depreciation account. But here, where items are on net book value, we even have, we can incorporate depreciation in here, okay? Depreciation is deducted directly from the PPE account to determine to the net book value. So once I have these two values, I'm now going to read my text here. When you come down here, they are telling you that plant and property and equipment as at 1st May 2017 had a cost of 500 million. So basically it had a cost of 500 million. Here we can strongly say that the accumulated depreciation at that stage was about 100 million, because they are giving us 400,000 as that, but that you don't bring it at this level, since our account is based on net book values. So they're also telling us that during the year, property, plant, and equipment acquired on 1st May 2016 had a cost of 50 million. So there was an acquisition of 50 million. Okay, they're saying, sorry, during the year, property that had been acquired on 1st May 2016 and had a cost of 50 million was disposed of. This is not an addition, this was a disposal. So there was a disposal of assets, and the asset was at 50 million. Okay, the asset had a cost of 50 million, but at that point in time, it was valued at 36 million. So now what I'm going to basically do, remember, I'm running my account based on what? Based on net book values, okay? I'm handling my account based on net book values. So it means that I'm going to basically use the net book value instead. So right here, we have they're telling us it was disposed of on 1st November 2017. So I'm going to transfer that value within my what? Within my account. So disposal of asset. Its net book value was 36,000. So that is the first thing that I'm trying to do. So this is one of the reasons that why we had a change. Now, in addition to that, again, they're telling us the profit and loss on disposal has been accounted for in the statement of P&L. So we are going to look for that as well. But then they are also telling us that the accounting policy is to depreciate plant and property and equipment at accounting policy. Okay, depreciate plant and property and equipment at 20% on cost, and it is type apportioned. So we're also going to look at this. This we first leave it out. I want us now to also look at this. They're telling us that a revaluation of property, plant and equipment was carried out in April 2018, and it's incorporated in financial reports. Now, revaluation also affects our PPE account, because revaluation would mean that our assets have changed value. Now, when you come to our PPE account here, I want you to see critically. Do we see this section where we have 56,500 and 35,500? We see that clearly. Now here, the revaluation gain is actually the difference between this and this, which is this is 56,500. This is 21. 5 minus 3 is 2. Then 6 minus 5 is 1. And then the 500 basically dies out. So what we are going to basically do is we are going to come here and post the revaluation that happened. That revaluation account only changes because of a new revaluation. So there was a new revaluation to the tune of, is it 21 that we got? 21,000 that we have calculated the difference between the beginning and the closing value of our revaluation. So that is one of the things that we basically have there. So we've brought in that. Now, we also have to, again, go back into our narration. We are trying to look for all information that relates to PPE that we have been provided, so that we can be able to take into consideration everything. So we've recognized this. We have also telling us profit on disposal has been accounted for. So what we are going to basically do is they have also given us something to do with, let's see if we have any additions during the period. So when you look at this 400,000, and you look at this 456,150, you actually realize that there is actually there was an addition which they have not talked about within the text here, which we have to also determine, just like the way we are trying to determine our respective depreciation. So what we are going to basically do is we are going to come and utilize partly this information. So they are telling us here of the depreciation, which is at 20%. So when you come to here, we know very well that we have to look for depreciation, and depreciation would be which side? Depreciation would ideally be on the credit side. Depreciation is supposed to be here. Well, any additions will actually be reflected here, okay? But right now we have two values. We have the value of the additions and the value of depreciation that we basically have to be able to find. Now, what we can basically do is let's first calculate our depreciation. Now, in calculating our depreciation, I want to get your attention here. They have told us from here that they started plant property and equipment had a cost of 500 million at the start of the period. Okay. So that is one of the items that we are going to use to calculate our depreciation. So I'll just come here, say depreciation. Balance brought down, or PPE at the start of there is 500 million. I'll use the figures in full. 500 million. That reminds me, let me put these amounts because they're in thousands. Thousands. So we have 500 million. Now we also have, they are telling us that they disposed of an asset here, which had a cost of 50 million. And this was disposed of on 1st November 2017. So what we have to do is we have to find how many months were remaining before their end from 1st November 2017. So from 1st November, if our year is ending 30th April, we have the whole of November, December, January, February, and then March, and then April. So ideally, this asset was in place for 6 months before it was disposed of. So what that means is, look at here, they're telling us that the accounting policy is to depreciate plant and property and equipment at 20% on cost. And they're telling us that this is time apportioned. So that's why I'm trying to look at the 6 months. So what that means is when you come here to your calculation, we have the 500 million, but we also have the what was disposed of. Disposed of is 50 million. So when we are calculating depreciation, ours is to say that we had 500 million, but now after disposing of the 50 million, we remain with 450. So I would be right if I say that of this 500 million, we have 450. We have 450 million. That existed for all the 12 months. And then we have this 50 million that existed for only 6 months. So if my rate of depreciation is 50% or 20%, sorry, because they have given 20%, what I'm going to basically do is, okay, let's say this is number of months. This is the cost. Depreciation rate. This is 20%. So my depreciation is going to be, I'm basically going to get, for the 450, I'm going to do the full depreciation because it existed for all the 12 months. So it's just going to be 20% times 450 times 12 out of 12, just to demonstrate for you that because this one existed for all the 12, for what? For all the period. So this one gives you about, this is 90 million. Well, this will be only this times 20% times 6 out of 12 for the period it existed. So this gives you 95 million. So you basically get 95 million as your depreciation for the year. So what will happen is the 95 million will come here. I'll call it 95,000. Okay. And after this 95,000 comes here, I already have the disposal of asset. And then I also have the balance brought down here, then revaluation. This has basically exhausted whatever affects my PPE. So for me, what I'll basically proceed is to balance off this account and find the additions will basically be the balancing figure on each of the sides. So this side, the summation of this is 587, the 95 and this, and then right here, this is 42. So I'm going to have my additions to be the difference, which is just 587,150 minus 4,100. So that my two accounts are able to balance. Now back to my cash flow. Those calculations are important. We are going to use them. So one of the things that I'm going to add back is depreciation, which I've gotten. So my depreciation is 95. So I'll just call this 95,000. Again, these amounts are in shillings. 3 zeros, just to indicate. So what I'm adding as my depreciation is 95 right there. And this is as per working one that I've calculated. Now, the next thing that I'm going to look at is remember we said that if we have a profit on disposal, or loss on disposal, that's also another adjustment. So I'm now going to calculate my profit or loss on disposal. Now, again, I want to ask for your attention here. We have, they're telling us that during their property and plant and equipment that was had a cost of 50 million was disposed of on 1st November 2017 at 36 million. So what we are going to basically do is we are going to determine what was the net book value of this asset at the time of disposal. If this was its cost, what was the net book value for us to determine the profit or loss on disposal? Now, they have given us when this asset was actually acquired. So it was acquired on 1st May 2016. So let me just try to get to working here. I'll do this as my working too. So I'll say profit or loss on disposal. So the cost of asset disposed is 50 million. Now, they have not given me the accumulated depreciation, but I'm going to calculate it. So let me first write this. The proceeds from this asset are actually 36 million. The proceeds are 36 million. So I'm going to calculate my accumulated depreciation for this asset so that I can be able to determine the profit or loss on disposal. So what I'm going to basically do, this asset was bought on 1st of May 2016. So if I'm looking at the period ended 30th April 2018, and this asset was disposed of November 2017, I'm going to say that this asset existed from 1st May 2016 to 30th April 2017 was 1 year. So for this 1 year, it had full depreciation. So if it had full depreciation, means that if it was 50 million, means that this would be 50 million times the 20%. Which gets you 10 million. But then we also had another second year, which started 1st May 2017 to the time when it was sold off, which was 1st November 2017, which was half a year. These were 6 months. So we have 6 months. This means that we had, since our depreciation is on straight line, because that's what they have told us, depreciation is on cost. So straight line means that for this period, it was 50 million times 20%. times 6 out of 12, which is about 5 million. So what means here is that this asset had accumulated depreciation of the summation of this, which is 15,000, 15 million, sorry. So if this is accumulated depreciation, if you're doing your disposal, if you remember how we draw our disposal account, which we usually use to determine our profit or loss on disposal, I'll just try to draw it here for you and populate this information because it's going to help us determine profit or loss on disposal. So our disposal account usually has our asset. This case, the asset was just say PPE to be disposed of was 50 million. So let me do 50,000 and then put these figures are in shillings, 1,000. So 50 million is what we are disposing of. When it comes to the accumulated depreciation, it's on this side. Accumulated depreciation is 15 million. And when we get proceeds, we debit our bank because money is coming in and then we credit here. So proceeds, bank is written here as what we have gotten, 36 million. So this is 36,000. So remember when we are getting profit or loss on disposal, we compare these two sides and we say that if this side is more than this side, then we have a profit on disposal. If this side is more than this side, then we have a profit on disposal. Right here, it's the issue. When you add these two values, you get 51, here you get 50. So there is a profit. The balancing figure is a profit on disposal of 1,000. So this side will also have the same thing. So this profit on disposal, I'll take it to my what? To my cash flow statement and less it. So I'll pick here 1,000, bring it here, and I'm going to less it. The reason why I'm lessing it because the examiner even mentioned it, that the profit and loss on disposal is part of the profit for the period. Well, they were trying to mention it here. I think they said it here. They said the profit or loss on disposal has been accounted for in the profit and loss. So you should be able to picture that up and able to include it accordingly. Okay. So once that is so, I'm now going to proceed to my what? I'm going to proceed to my cash flow. So I'm right here. So I have adjusted this, and I've also adjusted that. So myself, I'm going to ask myself questions on whether I have any other adjusting entry that I have to make here before I look at changes in working capital. Now, when I look at what I've seen in the additional information, what is in the the profit and loss, I don't see any other adjustments. So I'm going to basically go ahead, like what we said within here, we say that after we have adjusted, we get what we call operating profit before working capital changes. So that's what you basically call it, operating profit before working capital changes. And then you work on the working capital changes. So that's the same thing I'll call it. So I'll come here. So before working capital changes, when you try to put all this together, you'll be able to come to about 113,740. Okay. Maybe not to confuse you. You can also call this cash flow from operating activities. At least maybe this one may be easier for you to remember since you have already cash flow from operating activities here. So cash flow from operating activities before working capital changes. That can also be how you call it. So that's what we have. Then now we're going to the working capital changes, since we have said before working capital changes. So I want you to look at the working capital changes because these are some of the areas where they are really what I usually regard as free marks. So I told you that for us to determine the working capital changes, we basically look at what? We look at the balance sheet, which is our statement of financial position. And we start with our current assets. So working capital changes, we have inventory. I'm going to see what exactly happened with inventory. Remember, always mind which year is here and which year is here. Now you can see that this is 2018, this is 2017. So this is the latest value. This was the value at the start of the year or the value of last year. So what this means is that your inventory reduced. So what you come and do, you come and write and say decrease in inventory. Okay, you say decrease in inventory. Now, what to exact write is depending on the difference. So you basically get this 103 and subtract it and subtract 78,365. Okay, I'll be able to comment on that. So PPE, you try to get this difference. It should be able to give you exactly what we have. So 103,100 103,100 minus this. I'll just demonstrate this here. So when you get this minus this, you come to 24. Now this decrease, this is the decrease in inventory. I'll come and put it here. Now it's either positive or negative. Now this 24,935, I'm going to regard it as a positive because a decrease in inventory means that you sold inventory. And whenever you sell inventory, means that it's a cash inflow. Inventory only reduces when you sell it unless additional information tells us otherwise. So that's why I make that a positive. So I'm going to go back to also look at other items of my working capital. So I'm now going to look at my trade receivables. As we can see, our trade receivables increased from 48 to 52. Now, receivables are the people that you demand. When they increase during the period, means that more money left the organization. So it is more of a cash outflow. In case they were reducing, means that the people you demand are paying you. But in this case, they are increasing, means that more money is actually moving out. So it's more of a cash outflow. So when you get the difference between these two values, you can use your calculator to determine the difference. I'll try to apply my Excel here. So you get the difference between this and this. This is 3790. So the 3790 is a cash outflow. I'll say increase in accounts receivable. And put the 3790 right here. That's what I'm going to basically do. So the 3790, what I'm also going to look at is another item of working capital. Now, like I said for bank, you don't touch it. Cash and bank, leave it out. Cash and bank, leave it out. Only look at other items of working capital other than cash and bank. So the other working capital items that I have is trade payables. Trade payables. So trade payables, when you look at this value and this value, we are seeing our trade payables reduced. Means that we paid money out to our suppliers for this to reduce. So this is a cash outflow as well. So you get the difference between these two values. And then you should be able to include that as a cash outflow. In case it increased, means that you got more money during the period. So it would basically be a cash inflow, but this case is a cash. So I would say decrease in accounts payable. So this is, I'll just bring it here. Sorry, I didn't, this one is supposed to be a minus since it's cash outflow as well. Even this is also a minus. So that is how you proceed with the items of your working capital. So again, to note that taxation, bank overdraft, these ones are not touched. Dividends payable, no. When we speak of working capital, we are looking at inventory, receivables. We are looking at things like trade payables, okay? Those are the items that we look at. We don't touch taxation. Bank overdraft is just handled like cash and bank. Cash and bank is not looked at when we are looking at working capital in this case. So after we have adjusted our working capital, I remove this. We now proceed to look at other adjustments. Now, one of the other adjustments we are going to look at is the interest. We're going to look at interest. We are going to look at interest. Now, here, when we are looking at interest, we usually less the interest. But remember, the interest we less is the interest that was paid. Less interest paid. We are lessing the interest that was paid. Now, interest is an expense, but part of the interest may be unpaid. For cash flows, we only look at interest that has been paid, and that is deducted. Now, how do we determine interest that has been paid? But also to indicate that, like I said, the word interest also means finance costs. So how do we determine the interest that was actually paid? What we do is you can go ahead to look at the information they have provided to us. So one, we have this finance cost. This interest is interest for the year. This includes what has been paid and not paid. For you to determine what was actually paid, you come and look at to see if you have a liability. If you don't, for example, here we don't have a liability, means that all the interest up was actually paid, because this is the interest for the year. So you expect that if there's any that has not yet been paid, it would be under your liabilities. But here we don't have any. So whatever we have there was actually done what? Was actually paid. So what I'm going to do, I'm going to take that figure as it is, the other side. In case you had an item as finance cost here, you would go ahead to open up a tier account and calculate the interest that was actually paid. But in this case, I'm just going to take what we have, which is this 1530. So that is what I'll just take. So this is negative that. So also to note that this is a cash outflow because we are paying. So I'm putting it as a negative, okay? Now, apart from interest, we also look at tax. So we also say less the tax that was paid. Less taxes that were paid. Again, here we're also looking at taxes that were paid. Now you're going to see how this is different. When you look at our question here, we have the tax, this 8250. But when you go to the balance sheet, we also have taxation. We have this of 2017 as end of 2017. We also have this as one of 2018. Now what we do here, I want again to borrow the idea of a tier account. So I'm going to come here. Let's say this is, let me call this my working 3. So if it's working 3, so let me just call it a taxation account. Now, the tax is a liability in this case. And that's why we are seeing it appearing in the liabilities of our records. So we have a balance brought down on the credit side. So we have this, just a moment. So I was saying that for taxation, this is our balance brought down, 6750. So you bring it here in the taxation account. You say balance brought down of 6 that, and then you have your balance. You have your balance carried down. Your balance carried down from what we have when you come here is 8,250. So I'll bring that right here. Now, like I said, this is a liability. Balance brought down is on this side, balance carried down is on this side. Now, we have the taxes for the year. Now, the taxes for the year increase your obligation. So they will be on this side, taxes for the year. Now, the taxes for the year is what we have in our profit and loss, which is ideally, the taxes for the year is 8,250. So the 8,250, I'll bring it here. So if we have a balance brought down and balance carried down, and then we have the tax for the year, we know very well that what would reduce the obligations is taxation paid, and this will be on the credit side, the tax paid, and it's what we are exactly looking for. We are looking for the tax paid. So since we already have the balance brought down and balance carried down, we can just go ahead to add these two sides and get the difference. So when you add this side, you get 15,000. When you add this side, you get 8,250. So it means that the taxation paid is 15,000 minus 8,250, which gives you that. So this side will have 15,000. This side will also have 15,000. This is what we basically do have. So I've used the tier account to determine this 6,750. Whenever you have the balance brought down and balance carried down, you just look for what increases and what reduces such an account. And what you have, you write it there, and then you calculate what you don't have. Now, I just want to draw your attention that another student would have been able to see this clearly, because if the obligation for there is 8,250, and when they come here to our what? To our balance sheet, they started with 6,750, but their current obligation is 8,250. So means that the only obligation they have is the obligation of this year. So it means that the obligation of last year was cleared off. So that is why even in our calculation here, we've been able to determine the 6,750 as what was actually paid during the year. So this that was paid during the year, you bring that tax paid, you now bring it to your cash flow statement. It's also a cash outflow. So this is 6,750. You come bring it here and put a negative on it. So 6,750 is a negative, which we bring there. So after you've adjusted, because we've adjusted working capital, we've also adjusted interest and taxes paid. You should be able to get your cash flows from operating activities, okay? You should be able to get your cash flows, or what you can call it total cash flows, just like the way we saw here. Remember what we talked about here. You can get, after you've adjusted the taxes paid and the interest as well, you're able to come to your net cash flows from operating activities. So that is what we are going to basically include here. Say net cash flows from operating activities. You can see that the whatever I left as space has been able to work for me. So you also make sure that you leave enough space. So what I'll get, since I have this value here, I'll just adjust it with these other values. You can now add from your side. Myself, I'll just use that. So it will give me 119,660 as my net cash flows from operating activities. So this is how the indirect method is. You can see that we have had to work around to determine this, not really directly. Okay, so it's the same way why they call it indirect method. You have to go through a lots of things, balance here, try to do a tier accounts for some items like interest and maybe taxation, until when you're able to determine what is your so-called what is your so-called cash flows from operating activities. So then we have the cash flows from investing activities. We already had an item of interest received. Now I want to again say that for investing activities, we look at basically PPE, and from what we saw here is the first thing is proceeds from sale of fixed assets, and then also any purchases of fixed intangible assets. So from our question, we already realized that they gave us, we had proceeds. Remember the proceeds we had, these ones of 36 million. So these proceeds are one of the things that we are going to include in our cash flows from investing activities. So what you basically do is you go to your cash flow statement and say, in addition to this, you say proceeds from disposal. And it is 36 million, it is 36,000, like so. Now, the other thing that you look at is the acquisition of the assets, because they have told us purchase of fixed assets. So you look at how much you spent in acquiring a new asset. So from here, remember they told us about an acquisition. Okay, they didn't speak of an acquisition, but once we calculated, we saw that there was an acquisition, okay? And we went ahead to draw up one of our accounts where we're trying to show how the assets account happened. So we have a balance brought down of 400,000, and then we got our depreciation, then we had our revaluation, then we were able to determine our additions. Just to comment on this, earlier on we had used 36,000, but this is supposed to be 35,000. Now, why it is 35,000, not 36,000, is because this is a PPE account. And what we record in the PPE account is basically, now in this PPE account, we are looking at figures at net book value. So when you're trying to adjust for the disposal of the asset, you adjust with the net book value of that asset. So you remember us, we have come here, we came here and determined the net book value of our asset, because our asset was 50 million. This is the cost of the asset, and the accumulated depreciation was 15 million. So it means that the net book value of this asset that we disposed of was basically the 50 million. It was basically the 50 million minus the 15 million, which would definitely give you 35 million. So the 35 million is what is credited in our so-called PPE account, okay? So that is very important. So that's what is right here, 35. So when you balanced off this account, you're able to determine, just a moment, let's try to, let me just try to redo this. This is 586. It's basically the balancing figure, 586,150 minus 421,000, which is 165,150. So this 165,150 represents the additions that happened during the period. So you just bring it here and say additions. You can say additions to PPE. And this is usually payments for additions to PPE worthy this amount. Now, interest received was a cash inflow. We put it as a positive. Proceeds were a cash inflow. This one will be a negative because it's a cash outflow. Now, these figures are not given direct, as we've seen here. We've gone ahead to calculate it. So you just need to learn the concept of how to draw up an account and use the information provided, and later be able to determine what is the information that is not available. So that is very important for us. So once we have gotten that and we've input it basically within our what? Within here, ours is to look around and see, do we have any other item of that would go under investing activity? Now we've taken into consideration the interest received, the acquisition. Now, when you also go, when you come and analyze your balance sheet here, you come to see that this we have looked at it. Now, there's another item here called investment at cost. Now, this investment at cost didn't exist. There's nothing in 2017, it's just zero. But then we have a figure in 2018, which means that we acquired some investments during the period, which means there's an outflow. So that acquisition of investments, you come and record it in your what? In your cash flow from investing activities. You say investment acquisition. But value, so I'll put it that, but it will be a negative since it's a cash outflow. Money is getting out in that case. So again, you go back and see, is there anything else? So, and most of that information for investing activities will be gotten under your non-current assets. So we have looked at this. We've also looked at this. The next thing is now to look at any other item which I don't seem to see here, or sometimes they can put in additional information. So if that is the case, we now again proceed to look at we can get our total here for cash flows from investing activities before we proceed the other side. So this is you can call it net cash flows. Net cash flows from investing activities. So this is, I'm just going to add up this. So it gives me 339,150. So I have a lot of space here. What you usually do here is you just cross this space and then now move to this in the exam. I left more than that, what I need, and no one will penalize you. So cash flows from financing activity, which we said here, we look at the loans and look at shares, items of financing. We also look at dividends and so on. So when I come to my information here, I'm going to see that is usually under equity and liabilities. So we can see that our share capital was 302 and it is now 450. And then our share premium also changed. Okay. Now what I'm going to basically do here, we also have additional information about that. So they're telling us that during there was a cash issue of 925 at 2,000 per share. So we're going to calculate the proceeds, because what we are looking for here, basically under our cash flows from financing activities, is what we call the cash proceeds from the issue of shares. So cash proceeds from issue of shares. So let's try to see something here. Let me try to add another working. Maybe this is working, this was working 3, this is working 4. So call it working 4 and say proceeds from share issue. So our question here, there were 995 shares at 2,000. So I'll just put that and multiply it by 1,000. So this is this times 2,000, which is this times this. So it basically gives us, this is 181,850,000. So these proceeds, the way they are, I'll just come here and write them. I'll just try to remember my column. So this is the column. This is 181,850. 181,850. That is what we basically have as our proceeds from issue of shares. Now, just so you know that the dynamics of what belongs to share premium and share capital, maybe I'll just comment about this. If I wanted to determine exactly what is my share premium and what's my share capital, I'll do this. I'll just want to comment on this because you might need this information somewhere. So share capital, if I was to calculate share capital, I was going to get the number of shares, which is 90,925. But this case, this time I'm not going to multiply it by 2,000 because 2,000 was the proceeds. What I'll multiply it with is the nominal value. Now, by nominal value, they have given us the nominal value because when you look at our question here, we have a nominal value of 1,100. So when you come here, 1,100 multiplied by the number of shares that were issued, we'll be able to give you the share capital. So when we add, when we multiply this, this times this, you come to 107,500. Now for share premium, it will be the number of shares, share premium, to be the number of shares multiplied by the difference between the rate at which we sold minus the nominal value, which is 900. So it will be 900 times the number of shares, which is giving us 81,832,500. Now, you might want to test it because when you look at this, let's just try to look at our so-called share premium. It was 79 and it's now 113,400. Let's just try to see if this matches. So this was these are the values. So let me just try to get the difference between those two values. So the difference between this and this is about 34. Is it 34? Is 34,350. Now, we might have other shares that were not issued at cash basis, which are bringing about this difference, not correlate. But in real terms, if at all we had only issued these shares here, they have only been able to tell us about the cash issue. But there can also be other issues of shares. They can be issues like rights issue, where it's already existing shareholders that are given shares, additional shares. You can also have bonus issues. Bonus issues of shares are usually given to corporate heads like CEOs. They are given shares in the company, but they don't pay money. These shares can be given maybe as part of their bonus. If they have performed very well, instead of giving them money, they can give them rather shares. Now, these shares, there is no cash that comes in. So that could be one of the reasons why we are seeing that difference. But ideally, for the reasons of for the cash flow, basically, we only look at the cash proceeds. So we get the total sum of how much we received, and that is what we basically put here. So I just wanted to comment on that. Now, apart from cash flows from the issue of shares, what else we include under financing activities is the aspect of we have a loan. When you come up here, we have a loan. We had 56,250 and it is now 71,250. So you know very well that this increment is due to an acquisition of a new loan. So you just come and calculate that. When you get the difference between these two values, 71, and this is 71,250 minus 56,250. It gives you 15,000. So 15,000 is the new loan that was acquired. So you just come here and you can say maybe proceeds from new acquired loan. This is 15,000. So the next thing you have to look at, again, I draw you to the format, which is one of the things that you can take and basically look at. You can see that we have proceeds from issue of shares or debentures. You have proceeds from other long-term borrowings, like we've seen a loan. In case we are repaying any loan, we'll bring it here. In case we are any redemptions and so on, we'll also bring it there. Now, one of the other things that they have not mentioned there, but we also do it, is looking at the dividends, because dividends also deal with to do with financing. So what to do, we have something called dividends payable within our balance sheet, but we also have our dividends for the year. Now, to calculate the dividends that were paid during the year, we draw up an account just like the one we drew up, the one of taxation. So what we shall do is I'll just come here and draw up an account for dividends. I'll just come here. I'm just drawing up a dividends payable account so that to determine the dividends that were paid during there. So this is dividends payable account. So the dividends payable account, I'm going to have my balance brought down. Since this is a liability, this will be my balance brought down and this will be my balance carried down. So balance brought down. That value. Then my balance carried down is this value. So what increases the obligation for the year is dividends for the year, recorded here. And what reduces the value is dividends that were paid in the year. Let's say dividends paid. Now from our P&L, these dividends that we have in the P&L are the dividends for the year. This. So I'll put them here. So we started with 14,800 at the start of the year. We had 25,160 as the dividends for the year, and then we closed with 142,500. So it means that the difference is what was actually paid during the year. So for me to determine the difference, I'll just get this total and subtract this one. So this is 39,960, and then I have 12,500. So this is 39,960 minus 12,500. So it gets me 27,460. When I add this side, it should be able to add up. So these dividends that were paid in the year, I come here and remove them. But there will now be a negative. This will be a negative. I'll put it here and I'll put a negative on it because it's an outflow. Whenever you pay dividends out, they are more of an outflow. So after I've done that, I'll just look to see, do I have any other item of financing activities? I don't seem to have any, so I'll get my net cash flows from financing activities. So financing activities, this one, I'll just add up this. This is 169, 3990, as we can see there. So I now go ahead to determine, because I've gotten all this. Remember what we had here. I just remind you. After we have gotten our net cash flows from financing activities, we get what is called net cash and cash equivalents, which adds, you add your cash flows from financing activities to the cash flows from investing activities to the cash flows from operating activities, okay? So that is what you basically do. So I have my net cash, net cash and cash equivalents. Net cash and cash equivalents for the period, okay? Because this is, I'm now going to add this plus this plus this. So this will be sum, this, this, this. So it gives us 50,100. Now, after you have done so, again, I want to draw your attention to our format, which can help. When you come here, you're supposed to add the cash and cash equivalents at the beginning of the year. Add cash and cash equivalents at the beginning of the year. Add cash equivalents at the start of the year. Now, how you determine the cash and cash equivalents at the start of the year is you come to your balance sheet. You come to your balance sheet and pick what is under cash and bank for 2017. So what is under cash and bank for 2017 is 15,105. There is nothing for 2018. What we have is a bank overdraft. It's included under liabilities. So you bring this right here. You put it there. It is an addition. In case it was an overdraft, you'd reduce it, okay? But this time it's a positive. Now, after you have done that, again, you now go ahead to determine the cash and cash equivalents at the end of the year. So you just go ahead to say the cash and cash equivalents at the end of the year. Now, the cash and cash equivalents at the end of the year is basically the summation of these two values, which gives us 34,995. It gives us 34,995. Now, that 34,995 is supposed to be your cash balance at the end of the year. Now, for cash flow purposes, that is the last figure that you have in your cash flow. This is the final figure that is usually in the cash flow. So what we do, after getting this figure, you go to your cash flow. Okay, you go to your balance sheet and see if that was the closing balance. So when you come to here, when you come to your cash and cash equivalents, remember here we said we don't have anything, but it's in under liabilities. So when you come here, we see that our bank overdraft is 34,995. So since our bank overdraft is 34,995, it ideally means that we have been able to determine and reconcile our cash flow statement, because this 34,995 exactly matches what we have determined here within our cash flow statement. So that's how you draw up your cash flow statement. So this space, in case you're in your paper, you can be able to just cancel it out and you have your cash flow statement. So I believe that you've been able to get something from how to prepare a cash flow statement. And I believe that even if it's a direct method, you remember what I said with the direct method, you put items as they are. They'll give you the cash sales, they'll give you receipts from debtors, they'll give you payments for raw materials, they'll give you payment for wages directly without having to look for them. For the indirect, you start from the net profit. Usually this net profit is the one that is before tax. And then you're able to work backwards to add certain items to less them, just like the way we have done in this question, okay? So that is how cash flows are prepared. In case we have any questions, I'll be able to take those and then we'll be able to call this a session. Any questions for those that are watching this live? Or any comment? Thank you so much, Hope, for your comment. I believe we've been able to tackle that. Any other comment? Or any other question from this? Okay, so I believe that we've been able to tackle what we needed to tackle. So this is a number that you not find so much in many papers, but the examiner can set it. So what I encourage you is take your time to understand it so that you can be able to derive information from it, but also even in objectives, somebody can bring you and say the following items are under cash flows from operating activities. And then they give you different items, maybe including some items under investing activities. And then you have to determine, you have to be able to do what? To be able to select which one is right. So, and then this information can also help you in your real life. Definitely, you'll be required to draw up a statement of cash flows one time, or even in interviews, they can ask you about the statement of cash flows and what you know about it and what are the components in the cash flow statement. So make sure that you know what undergoes under cash flows from investing activities, from operating activities, and so on, because that is the very key thing. And then whatever information you're provided, then you can always juggle out and determine what exactly goes there. All right. So Thank you so much, and wish you the best. All this. Bye for now.